So I think we're leveling off on everybody coming in. So why don't we go ahead and get started, and then we might have a few stragglers that'll join us in a little bit. So I want to thank everybody for joining and being on time as well. So today is Wednesday, August 17th, 2022. It's great to see a lot of familiar faces for everybody that's logging in. It's nice that we've got another good crowd today. So a couple of housekeeping items to kick us off. So everyone does come into this webcast muted, but we do encourage you to ask questions. So throughout the presentation, at the bottom of your Zoom screen, there is a Q&A feature, and we'll try to answer questions as we go. We've got about 40 minutes of prepared remarks, and then we'll try to wrap up to the top of the hour, answering any more questions that comes in. So the webcast is being recorded and will be posted to our website in the coming days. We'll also make the slides that we covered today available for anybody that wants them. So give us a call, shoot us an email if you want to see a recap of what we have. So in our last webcast back in May, we introduced our newest advisor, Karina Olson, who's joining us here today. She's hit the ground running and has already started working with some of you. So she's joining Jake, Linda, and myself today. As we're trying to balance out how many people we have presenting, we've actually given David the day off, but I know he can't stay too far away, so he's actually logged in as a client. So can't wait to see what his questions are for the Q&A.
Yeah.
So we'll continue to mess with our recipe on who's presenting. We'll rotate from quarter to quarter. So, but it's nice to have Karina joining us today. So with that, here's our agenda today. We're going to go through what we've titled for most of this year, Transition 2022, and look at what's changed since the beginning of the year. We'll, of course, cover the economy as well as the current events, and then how that really translates into the markets that we all know and love at this point. And then we'll wrap up with the financial planning tip, and then, like I said, move to the Q&A for the rest of the hour. So in the last few webinars, we've been talking about 2022 being a year of transition. So when we started this year in our February webcast, we painted the picture that you see here on the slide. We tried to outline in the middle what we thought would be our base case for the rest of the year, along with a best case, worst case scenario. So now that it's August, we wanted to take a look back, see how things have panned out so far. And I would say, as you see with the check marks, most of the base case that we had outlined has played out. There's a few points in the worst case box that have transpired. As you can see, we did enter a bear market. Market's down more than 20%. We've since recovered a bit, but that definitely came to fruition. And I would say most of us would argue that the Russia-Ukraine conflict has worsened. I'm not sure how long we feel like that's going to go, but it's not good in any sense. The question mark around the Fed policy, if they're making a mistake, are they raising too quickly or too much? I think that still has a little bit of time to play out on whether or not it's actually worse than we had expected, but more to come on that. And then, as you can see, none of the optimistic outlook that we had outlined has come to fruition, or at least not yet, since we still have a little bit of time before the end of the year. I think I read the other day there's 95 trading days left in the year with all the holidays coming up. So it's going to go by quickly. But with that said, so what's this all mean, though? One question we get, the media keeps batting around, is, are we in a recession? And interestingly enough, Karina and I were talking, Wikipedia had to change the way their recession definition page could be updated, because so many people were trying to go in and change. Is it 2 quarters? Is it not 2 quarters? And they had to kind of lock that down. So obviously ongoing debate with what's going on. So with that said, Jake's going to give you our viewpoint on that subject, in addition to a lot of the base case scenarios from here on out. So Jake, you want to take it away?
Yeah, thanks, Eric. I think that's what everybody's been asking, right? Is, are we in a recession? And I think this question stems from this graph, really, which is the second quarter of 2022. We had a negative GDP print for the second consecutive quarter in a row. GDP was down 0.9%, as you can see here on the right-hand side. And the last 10 times that we had 2 consecutive quarters of negative GDP growth, we were in a recession. So, I mean, that's, many would say, the technical definition of a recession, although we know that the National Bureau of Economic Research, NIBR, they're the ones that get to officially say whether we're in one or not. They have a variety of things that they look at. There's no like set formula that they have. But in general, what they look at is there a general contraction in production, sales, and employment? And nobody would have said we had that in Q1, even though we had a negative GDP print. We mentioned that several times. The biggest reason for that was in Q4, there was a lot of container ships that hadn't been able to offload, what they had on there. Most of that happened in Q1. And so we had this surge of imports, and that was the main driver of why we had a negative GDP print in Q1. So regardless of whether we officially get an announcement that we're in a recession, I think the thing that we look at is we're seeing some signs of slowing growth and a deceleration. And that was pretty evident in Q2. And I'll just give you 2 examples of what we mean by that. So this is manufacturing. And at the very top here is global manufacturing. And then there's some different areas as well as countries here on the left. And then on the right, you'll see some numbers. I know they're kind of small. So just think of it like this. If this number is above 50, it's going to be green. The darker the green, the better. If it's below 50, it's going to be red or orange. The darker the red, the worse it is. And then I've highlighted really 2 time frames, and these were, the previous 2 recessions that we had. And as you can see, there's a lot of red during that time, both of these times. And that's the big contrast that we see today, is there's actually a lot of green going on. I mean, we see a little bit in Russia, obviously, with the war, with China, given their COVID policy. But that's what's going on. So manufacturing looks pretty good, but the thing I want to point out is just this. So this is May and June. The May numbers were at 53 and down to 51. So this is the slowing that we're talking about and referencing. I think the other thing to point out, and you guys, everybody sees this in their own neighborhoods, but home sales are slowing, right? Since January, existing home sales are down about 21%. And it's not surprising given the increase in prices as well as interest rates going up. But at the beginning of the year, there's probably 70% of homes that were for sale that were going through bidding wars. That's down to 40%. I think we continue to see, houses stay on the market a little longer. You also see that I think the national average was 8% of homes have now cut their asking price in the last 4 weeks. And I think
we've actually seen, I'm sorry, Jake, we've actually seen that number a lot higher here in Arizona. I've seen over 60% of homes in the last 60 days have lowered their prices.
Yeah, wow. So that's a much bigger number than the national average. So we're seeing the impacts of the higher prices as well as the mortgage rates. I mean, it's definitely taking a hold on the economy. But going back to GDP, I mean, over the last 20 years, we've been growing at about 2% on average. And we foresee that continuing for the foreseeable future. And it's probably been a while since you were in Econ 101, so I thought it might be good to do a little refresher of what GDP is. But basically, all GDP is it's the value of all economic goods and services that a country produces during a specific time. And it's made up of these components here on the right-hand side. It's made up of consumer spending, government spending, and then all of the investments that a country makes through capital equipment and housing. And then you also add in net exports, which net exports is just what a country exports minus what they import. And so the formula is pretty simple there. But the thing we ask ourselves is, what's the health of these areas? What's the health of the consumer, governments, and corporations? And that's something I thought it would be worthwhile to walk you through and talk through this. And the biggest component, as you can see, is consumers. I mean, nearly 68, almost 70% is the consumer. And so, you've heard David talk about this a lot, which is, the consumers are in a lot better shape than they've been in. And I think this graphic kind of illustrates that. This is what we call the household debt service ratio. So it's just what percentage of your disposable income are debt payments. And as you can see, we're a lot lower than we were back in 2008, and even lower than we were back in the 80s. And I think the main reason for this has been we've had house prices go up. We've had low interest rates, so people have been able to get low rates on their mortgage. And that's been probably the primary driver for, this debt service ratio being as low as it is. So that's just one example of why we think consumers are in better shape right now. The other thing is when we look at corporations, Q2 earnings actually came in better than expected. There was a lot of worry that that because of some of the negative guidance and profits that were announced by like Walmart and Target, that this was going to be much, more widespread just due to the, inflation and the tight labor markets. But surprisingly, the Q2 earnings were actually, better than expected. And I would say one positive takeaway from the last earnings season was in the first quarter, if you missed your earnings, your stock got just hammered. You got pretty severe price drop if you missed earnings or even had negative guidance. In Q2, it was a little different. We saw that when companies missed earnings, they didn't get hit as bad as maybe they did in Q1. So that was a positive sign. The other thing we just wanted to illustrate is the forward analyst estimates. Now, they're generally overly optimistic, and we probably think that's the case again. But we still believe they'll be positive here. The other thing is profit margins. I mean, they've definitely compressed from the first of the year. But when you look historically where you're at, I mean, you're still at really strong levels. So, corporations seem to be in decent shape. They're definitely having to try to fight the effects of inflation and some of the labor issues that we're seeing. So as we turn to kind of government spending, I mean, as you can see, the government appears to be getting back to spending levels where they were in pre-pandemic. Obviously, they were astronomical during the COVID times here. I would note that we're still running a deficit. We foresee that continuing for a while. In fact, I kind of noted that I feel like this graph ought to be flipped upside down. As you can see, these are negative numbers over here. So if the bar chart's up, that means we're at a deficit. We haven't been at a budget surplus since the early 2000s. So as we look at states, though, what's the health of the states? And surprisingly, in 2022, we've seen nearly all states they're expecting tax collections to be above projections, above their budget forecasts. In fact, this marks the second consecutive year that this has happened. And Karina and I were kind of joking. It's like, who's the one state that hasn't, it's not pulling their weight here? So
I know we all took our guesses. We were all wrong. Personally, I guess Mississippi, after spending some time there a couple of years ago, lived out there for a bit. But after digging through the report, we discovered it's actually Wyoming is the one state that's reporting lower than their projections.
Wyoming needs to pick it up. Yeah, but I would say this. I mean, 2021 and 2022, we're probably still seeing some of the economic impact of some of the federal stimulus that we saw in 2020. I'd also say that just increased consumption and the strong labor markets, wage growth has probably been some of the big drivers for why states' revenues have been decent. And we're probably seeing the vast majority of probably the more states that are have budget surpluses than we've seen in a long time. So these are some of the reasons why we feel like if we're either in a recession or will be in one, or have been in one, some of the reasons why we see it being more mild or not a deep recession, but things could change. They certainly can change in a hurry, but the health of the consumer, corporations, and governments are things that we look at. I'd also say that many economists, are not convinced that we're in a recession because of the labor market. I mean, Linda, do you feel like we can have a recession when labor is as strong as it is right now?
It's kind of hard to imagine if you look at the employment market right now. This picture might look familiar to a lot of you. Back in the housing crisis of 2008, we often brought this graph to the reviews. This is the story of job recovery. So what we're looking at is every recession since 1948 with the percentage of job losses on the y-axis. And then along the bottom, we have the number of months it took from the start of the recession to recover all the jobs lost. And the picture says it all. We've seen both a record number of jobs lost with the pandemic and then a record recovery of those jobs. So all other recessions really have paled in comparison. Today's unemployment number is 3.5%. We haven't seen that low a number since 1969. We are, however, hearing some rumblings, beginning to hear about some large layoffs or hiring freezes or travel freezes. These are all early signs of weakness coming to the labor market and can be seen in the form of first-time claims for unemployment. They are on the rise, as you see here from this graphic. This tends to be an early warning indicator, leading indicator that we have a softening labor market. That being said, I want to remind everybody that at the beginning of the year, when we talked about how crazy this labor market was, there were 2 job openings for every 1 person looking for a job. So the significance of that now is we can lose a lot of jobs or potential job openings and still have an exceedingly low unemployment level. So I suspect that between a robust employment market and then higher wages, right? We're up over 10% on average across the country. Then shortages now created by supply chains, all these things have combined, of course, to drive inflation higher. So June saw our peak, or perhaps what we hope is our peak, with the Consumer Price Index, or CPI, at 9.1%. Now, the Federal Reserve would like this to be closer to 2%, and we're a ways from there yet. We saw our first glimmer of hope here with the July CPI number, as that came in slightly lower than 8.5%. But 1 month does not a trend make. So let's look at what we mean by CPI, and then where have we been seeing that improvement? So Consumer Price Index, or CPI, is composed of 3 major sections of the economy. First, we have food. Here we've seen across the board almost double-digit increases. Cereal and bread probably being driven by the war in Russia, Ukraine. They produce 25% of the world's wheat, so that's obviously impacting prices there. Eggs have been, and poultry have been hit hard because of the bird flu. That decimated some flocks in the poultry and egg supply chain. And then, of course, all of these categories, transportation costs factor into their costs because most of our food is transported from some other place. So the second category is energy. Now, anybody want to volunteer the lowest price you've ever paid for gas at the pump?
I know you're going to pick on me, so I'll just go ahead and go first here. But I have actually paid as low as $1.60. And if you count my Fry's fuel points, it was even less than that.
Jake, you got a better story?
Yeah, I was probably just below $1 back in 1999. So.
Yes. Well, obviously I'm the baby boomer on the panel here. Try 27 cents a gallon. Now, I wasn't a driver then. That was what my parents were paying when they were driving. And we got green stamps. Remember those? With every purchase. It was kind of the equivalent of your Fry's fuel points, Karina. You got green stamps with every purchase. that you could collect and then trade that in for dishware.
I don't remember green stamps.
Okay, acknowledged. I'm old. Well, unless you're one of my smart friends driving an electric vehicle, we've all experienced the pain at the pump this year with 44% increases in our price per gallon. Now, some of these increases have been driven by demand, right? A lot of us are back to in-person work, or we've been taking COVID revenge vacations, and certainly avoiding flying by driving. The other pressure point has been the Russian war with Ukraine, and that has shocked some of the global oil supply and driven prices higher. So then the third category for CPI, which we astutely call other, is basically everything that isn't energy or food. And here what we see is that the CPI says the largest percentage point increase here was airfares. And the culprit being airfares at 27% increases year over year. Given the nightmare this summer travel season has been, I think the word culprit is appropriately used here. I saw this article yesterday that said that a flight from Europe to New Jersey got diverted to Nova Scotia because the flight crew had reached their max hours. I don't think I've ever heard anything like that. I mean, stuff like this just shouldn't be happening, right? But I digress, right? So housing or shelter is also an important component of this category. And you might be surprised by a mere increase of 5.7%. I know you would not be alone in that surprise. So Karina and I were laughing about this morning because she said, I don't buy anywhere near as much in eggs as I pay for shelter. And she's right. When we look at shelter costs as a percentage of CPI, it's actually 32%. So it's a very big part of this calculation. And we would argue the 5.7% is not an appropriate reading. The reality is we've seen rents across the country just skyrocket. In fact, Arizona has the dubious honor of having both Phoenix and Tucson in the top 4 cities with the highest year-over-year rent increases, almost 30%. So what's with the 5.7? Well, it has to do with the way this particular data is calculated. And I'm going to spare you the nitty-gritty. You're welcome to come into the office, and David, I'm sure, will take you through those calculations happily. But suffice it to say, it is low here. We do expect it to go higher as these calculations finally pick up with what we've been seeing. So July's CPI brought some welcome news, a decline from 9.1 to 8.5. And the improvement was largely driven by lower oil prices. But we also saw some small declines in clothing costs and utilities. However, a lot of things were still on the rise. Now, markets rallied off of this news as the Federal Reserve is looking for inflation to begin to reverse direction if they're going to slow the pace and the number of their interest rate increases. But again, I remind you, 1 month does not a trend make. So we need to continue to be cautious here. So let's talk about the Federal Reserve for a moment. They have 2 mandates. The first is full employment, and the second is price stability. Full employment, I think we can check that one off the list. Price stability refers to inflation, of course, and here they target 2%. At 9.1 or even 8.5, we still have a way to go before they feel their policies are beginning to work. So to fight inflation, they have 2 policy tools. The first is raising the short-term lending rate. Now, this is the rate that tells us what you and I get to earn on savings accounts or certificates of deposit. Short-term rates do not establish mortgage rates, but they are related and will often move in the same direction, even if not in direct proportion. So at the start of the year, the short-term lending rate sat at just 0.25% after being at 0 since the start of the pandemic. In January, estimates from the Federal Reserve that they told us that they were going to raise rates 4 times and they were going to do so in increments of 0.25%. But when those inflation numbers quickly elevated, this became a very challenging situation for the Federal Reserve, and they rapidly stepped up the plan, jumping up to 0.5% at the next increase and then 0.75% at the last 2 meetings. Now, we can see what the market thinks is going to happen with interest rates. And the Federal Reserve does something called a dot plot to give us their indication of where they think are going to happen to interest rates. And that's what you're seeing here on this graph, what's happened. And then the market's expectation is between now and next summer, we'll jump another 1%. So rates continue to go up. The Federal Reserve, however, if you look at those red stars, that's their dot plot. They believe, or a little more hawkish, they think a full 1.5%. So that by this time next summer, market says 3.25 to 3.5. Federal Reserve is saying 4%. Now, this has the potential to bring volatility back to both bond and stock markets, because if we see a mismatch in expectations, it's that lacking expectation that markets get very upset about.
And I think, Linda, to that point, I mean, that's one of the reasons why we've seen the market rally pretty strongly here, is the expectation that, hey, maybe the Fed is going to be cutting rates next year. They won't have to raise as much. And so
Absolutely.
there's a big disconnect, right? So
there is. And so somebody's going to be wrong. So we're going to have to see how that plays out. So the second policy tool that the Federal Reserve has is a decrease in their balance sheet. Now, the Federal Reserve balance sheet is just their own bank account that they use to buy mostly mortgages, also treasuries. And in fact, until 2008, it was just treasuries. And this helps them make for a smooth and orderly market. At the start of the pandemic, they extended their purchases to include almost any type of debt in order to ensure liquidity at a very tenuous time in our country's history. And that definitely helped calm markets down at that point in time. When they did that, the balance sheet for the Federal Reserve was at $3 trillion. It has ballooned out to $9 trillion today. What they want to do now is to tighten or decrease the money supply. And they can do some of this either passively by simply allowing the debt that they hold to mature and then not reinvest those dollars, or they can be a bit more aggressive by selling the assets they hold in their bank account. So what we have on the balance sheet here, the green shows the current balance. The red dotted line indicates where the Federal Reserve now expect their balance to be. The initial phase, again, was just to allow debt to mature or mortgages to be refinanced and not reinvested. But refinance activity has come to a screeching halt as interest rates have risen for mortgages. So they haven't had the amount of debt being retired they anticipated. Now, starting in September, their plan is to be a little bit more aggressive and begin selling up to $95 billion per month in bonds back to investors. Given that they're now behind in projections, will they feel the need to sell even more than $95 billion? And what is this going to do to markets as this liquidity begins to leave the stock market? Thus far, Chairman Powell has been adamant, as he should be, about getting inflation under control. So we shouldn't expect him to back off on their plan, and at least not until we see the CPI data improving steadily. Again, 1 month does not a trend make. However, on Capitol Hill, inflation has become a rallying cry in this election season. So much so that they renamed the Build Back Better bill the Inflation Reduction Act. Will it really reduce inflation? Well, give me 10 years and I probably still won't be able to tell you. But let's take a quick look at some of the elements in the bill. Two primary categories. First is climate change. Many of the provisions in the bill promote the deployment of clean energy or mitigate climate change. This includes tax credits for electric vehicles, energy efficient home improvements, so appliances, storm windows or dual pane windows. It also extended the solar tax credit. The other big category is in healthcare. They are finally allowing Medicare to negotiate prices on some drugs. And this is estimated to save about $200 billion or more in cost to the program. And you got to know, this is brand new legislation, just signed in last night. There's going to be 50 different descriptions of what's in this bill and what the potential expense or cost savings is. So at the moment, just know these are the main elements. The rest of it's going to have to play out over time.
Really, I think last year in probably 2 webcasts, and I know in probably every client meeting, when it was Build Back Better and it was going to be 3 trillion or 2 trillion, a lot of our focus was on the financial planning impact, where it was, they were going to raise capital gains taxes, they were going to raise individual tax rates. I mean, there was a litany of things that were in the bill. And so to your point, while everybody's still teasing this out and the headline news continues to change, any potential financial planning tips that we have based off of what we see right now?
Yeah, and there's a lot in there, right? The other one point I want to make before I answer your question, Eric, is just that the Medicare costs being negotiated. The other benefit to our clients who are on our senior citizens who are on Medicare, they're capping out-of-pocket prescription costs at $2,000 a year and insulin costs at $35 a month. And again, that's just for senior citizens on Medicare. Obviously, to your point, how is this getting paid for? Of course, it's higher taxes in some areas. This includes a 15% tax on corporations, a minimum tax. Supposedly, this affects only 150 of the largest US firms and is estimated to raise, again, estimates vary, between 200 and 300 billion over the next decade. They're also taking aim at stock buybacks with a 1% surtax on the stock buybacks. Now, that's been a real popular thing for corporations to do with some of their spare cash, is buy back some of their stock. The 1% surtax on corporations who do that is supposed to help pay for some of these programs. And then the third and somewhat controversial thing is they're expanding the IRS involvement by hiring more revenue agents to go after people who have been avoiding paying their taxes or an appropriate amount of taxes. And I would say if you aren't cheating the IRS on what you owe in taxes, you probably have nothing to worry about. But to your point, Eric, what we saw now is that it's not just what's in the bill, but it's almost as important what's not in the bill. They did not make any changes to the 3.8% surtax rates. They kept the top tax brackets the same. And most important for most of our clients, they didn't close that loop on the backdoor Roth accounts. Now, we've held off getting everybody funded on those this year in anticipation that that would sneak into something before the end of the year. And at this point in time, doesn't look like that's going to happen. We're going to be able to go forward with helping everybody fund backdoor Roths who are eligible. So all good. We've had a lot going on, obviously, in the first half of 2022. Jake, would you like to take us through how all this has impacted the markets and portfolios?
Yeah, thanks, Linda. I probably don't need to belabor the point of what the markets have done this year. We've all kind of seen it and felt it this year. It's first half of the year has been, it really started out as one of the worst performances we've seen in the last 35 years. And so this graph, though, is similar to the one I showed you with manufacturing in that it kind of has some Christmas flavor to it. So Linda tends to like the Christmas colors.
Just the green parts, though, Jake, just the green parts.
Yeah, so to your point, yeah, green is good, red is bad. So this is just going the last 35 years. On the top part here are bonds. On the bottom are equities or stocks. And then just highlighting, the last two recessions, really. So obviously during those times, you saw a lot of red, mostly on the stock side. And that was the case. Generally, you see bonds kind of buoying stocks when stocks are down. You saw it both in 2000 to 2002, as well as 2008. There were areas. This year's a bit different. I mean, you're seeing across the board on the stock side as well as on the bond side. I mean, most things have been getting hit. There's obviously a few sectors and a few other asset classes that have made some money, but there's been very few places to hide. And the reason I point that out is when you look at, for a lot of retirees, they tend to rely on a balanced portfolio where they have part of their money getting dividends and income and are more stable from the bond side, and then part of it from the stock side for growth. And this is just a traditional 60-40 portfolio, but as you can see, because of both stocks and bonds having a very tough year, it's so far on record as one of the worst years in the last 40 years, roughly. So what we thought would be helpful is to just kind of point out just a couple of elements on what we're seeing with stocks and how we're positioned. And then I'll also point out a few things on the bond side, just what we're doing and how we're positioned. So let's talk about stocks. One of the main things I wanted to point out is just valuations. So the thing that you see in focus here is forward PE ratios, price to earning ratios. And over the last 25 years, those PE ratios have been around 16 to 17 times. For the last several years, valuations have been stretched, and we had been talking about that. At the beginning of the year, they were well over 20, and now we're seeing them after the first half of the year, they were below the 25-year average, and now they've come up here in the 16.5 to 17.5 range. So the main point I just really want to make is that they're not extremely attractive being way down here, but they're not as stretched as they were either. And so from the standpoint of our positioning on the stock investments, we're still relatively defensive. We haven't ignored the strong trend that we've seen. We've been able to add a little bit of small cap exposure to the portfolio, but we're predominantly in large companies right now. We think there's some added safety there. And then we do have a little bit of cash on the sidelines still, as well as we have a managed futures position that provides some diversification. So we've really seen this year our value strategies outperform and our growth strategies have lagged this year. And so the point I would maybe make is that come September, when the Fed begins to ramp up their quantitative tightening and their balance sheet reduction, that's one of the big questions we have, is how will the market react to that? So we'll continue to let our models kind of help drive those decisions that we make there. On the bond side, it's been a good year for us on the bond side, not so much for the general bonds. And this graphic is probably a little bit more complex than we need here, but at the bottom is just some different bond types. On the left-hand side is just their interest that they're paying, or their yield. And I mainly just want you to focus on these blue diamonds. This is just showing what the current yields are. And as you can see across the board, most of these are at or near or above, their 10-year average. So higher yields are really positive for the bond market going forward. And the reason for that is it can provide a little bit of buffer when you have some interest rate volatility. The other positive thing to note, and Linda alluded to this earlier with the Fed funds rate, is we've seen the 1-year Treasury rate increase dramatically. It started the year just under 0.4%, and now it's up in the 3.3% range. I mean, that's a big shift and a big move in a short period of time. And we haven't seen these 1-year Treasury rates as high as, this 3% range since, it's probably been about 15 years since we've seen it this high. So nice to be able to rejoice as a saver to get a little bit higher yield on what we deem safe money. And eventually, as Eric mentioned, money markets will try to catch up there. So maybe to turn the tide and talk a little bit about our bond portfolio. We've had a good year on the bond portfolio of being able to avoid some of these major declines. Had we stayed invested, we would have seen double-digit drops in the bond portfolio. But given our tactical nature, it's been able to not only protect and provide some dividends while we're in. But let me kind of walk you through this. This is just our high yield bond strategy, really over the last 3 years. And it's showing when we've sold out of high yield bonds with the red arrows. The green arrows show when we bought, and then the shaded areas just represent how long that trade persisted. And so as the trend started to move up in high yield bonds, about mid-July, we were able to start to get back in. And now we're fully invested into high yield corporates, into bank loans, and also into high yield municipals. We still do have a little bit of treasuries that we maintain, but this is a positive sign that trends have moved up. We've been able to get back in, and just in the last 3 weeks, we've been able to pick up a bit of return from that. So those are the things that I want to mention, both on the stock and the bond side. I think given that bonds have had a tough year, inflation's been the biggest problem, we thought it'd be worthwhile to go in a little bit more detail on some type of investment that you guys can look at as a way to kind of take advantage of that. So I'll let Karina kind of walk through this.
Thanks, Jake. Yeah, and what you're referring to is I-bonds. I know we've been getting a lot of questions on I-bonds. Actually, just had one yesterday, which was perfect leading up to this. So the big thing is, what exactly is an I-bond? It's not something we've been talking a lot about when inflation's been so low in recent times. What it is though, is it's a savings bond and it earns interest based on combining two different things: a fixed rate, which is normally pretty low and stays the same for the life of the entire bond, and then an inflation rate. And that inflation rate is actually set twice a year. So the reason they've been getting so much attention right now is that with those high inflation rates that Linda just went over with us, that means that the inflation rate on these I bonds has also increased. So for the bonds issued from May through October this year, that combined rate of the fixed and the inflation is actually 9.62%. I don't know about you, but that doesn't sound too bad to me, especially with some of those charts Jake just showed us. So I-bonds, they may be that safe place to hide. However, there are a couple of nuances that are really specific to I-bonds that we wanted to go over today. So the first thing is how you actually buy them and how much you can buy. So you can't buy these in your brokerage account. It can only be through the U.S. Treasury Department's website. That's actually the last bullet point here, linked below. So that does mean that we actually can't buy them for you either here at Copperwind. And there's also a limit to how much you can invest. You generally can't buy more than $10,000 per person or per registration. So if you have a trust, the trust could also buy them. And then there's also this other kind of option of taking $5,000 extra and purchasing paper bonds if you use your tax refund to do that. The other thing is, since you're buying them through that Treasury Direct website, there's no secondary market for them. You can't resell them. If you're going to cash them out, it has to be through that same website again. So new login, all of that to be able to redeem them. The other big thing that we get asked about a lot is how they're taxed. So the interest on them is subject to federal income tax, not state or local. There is one exception though to that federal income tax, and if you're using it for higher education. So these are something that could actually be used as a college savings tool. The last thing I want to highlight too that we also get a lot of questions about is any penalties for redeeming them early. So I-bonds are set to mature after 30 years. So meaning you could actually continually earn interest on them for those 30 years. Remember that interest though changes as inflation changes, but you can redeem them as early as 1 year after your initial purchase. But if you do actually cash in within those first 5 years, you're going to forfeit the last 3 months of interest earned. So just something to keep in mind with that. All in all, I-bonds may be an option for you depending on your financial situation. So something to consider. If you do have more questions about it, as always, you can just reach out to us and we'll talk about it with you specifically for your plan. But that's all I had on I-bonds. So I'm actually going to pass it back to Eric here to wrap up for us and lead the Q&A.
Great. Thanks, Karina. So as we started the year and as we started this presentation, we want to come back to this 2022 outlook slide, continuing the theme of transition for the year. So we still feel that the base case that you have in the middle here might be achievable by the end of the year, but that definitely doesn't mean that there's not going to be volatility for the rest of the ride. And so the academic discussion around recession and inflation is going to continue, but here at Copperwind, I think we all agree that things are slowing down and some things are more expensive. And those two things aren't going to change anytime soon. You know, the same conversation that I have during the winter living here in Phoenix. I called Jake. I'm like, it's freezing up in Salt Lake where you're at. And he's like, well, no, it actually only got down to 32 degrees. So it's not freezing. And for those of us that live in Arizona, it's like that's still cold. And so it's the same way. You could have zero GDP for an entire year, and technically you're not in a recession, but that still doesn't sound very good. And so we'll leave the academic discussion to the academics, but we'll continue to work through. So the base case is kind of where we're at least through the end of the year. So with that, we do have some questions we want to go through, and Linda, first one's for you. So kind of going back to the reference to inflation, you know, one of the headline numbers that comes up is, you know, the average household cost increase $750 a month due to inflation. So questions kind of, you know, do we feel like that's an accurate number? One, I would say it's an average. And so wanted to see if you wanted to address that on your Costco hot dog slide of here's all the things that are going up. Here's some of the things.
Yeah, no, I forgot to put that up. I wouldn't be surprised, but I think that number can be so variable based on where you are at in the country, what your socioeconomic status is. I honestly haven't seen that specific number. I think it goes without saying, stuff is more expensive for everybody. Inflation certainly has been a headwind to the consumer this year, kind of competing with the pandemic's over, doggone it, I'm going to go travel and I'm going to go spend money. So over time, you can't keep doing that. I'm sure costs have gone up.
And I think also that the headline stair steps, right? So if you were just to Google, how much is every household every month, that headline number keeps changing. And part of it is, and I'll do my best David impression, right? It's a survey that goes out. And if you call somebody right now and say, has your rent increased in the last month? And if your contract hasn't come up, you're going to say no, but if your contract ends next month, it's going to go up then, but you're answering the survey today saying that my cost has not increased from a household standpoint, and goes back to your shelter comment that, as we continue, and I think that's where you'll see that, whether it's $750 a month, or you go back at the beginning of the year, it was $250 a month. And I'm sure as we get towards the end of the year, inflation will continue and that number is going to keep changing.
And it's sad because higher inflation impacts everybody, right? I mean, it certainly impacts those with not as much wages or the lower class, right? But it impacts everybody. I mean, rising gas prices, rising energy, food prices. It just we all feel it, right? So
I know here in Arizona there was a comment recently that 75% of take-home pay for those in our lower socioeconomic area, which is South Phoenix here, 75% of their take-home pay is for shelter costs and food, leaving them very little, certainly nothing for emergencies, and very little for all the rest of the stuff. And that is going to be a damper on economic growth if that continues. That's why the feds have to stay on top of inflation. That's why that is important.
Yeah. So we've had a couple of different questions. I'll wrap them all into one. I think the question is, and as your compliance officer, I'll toss this to you softly. So has the stock market bottomed, right? So is this we saw the depths of the correction, or the other side of that question is, hey, is this just a bear market rally, which we've seen before? So Jake, I'll let you tiptoe around that one.
Well, it's obviously hard to say what it is, but it's, we've had a very strong rally. When you look at historically, when we've been in bear markets, it's not uncommon to see 5 to 15% rallies and then the market to roll over and hit lower lows. I think the most recent advance has been about 17%. We've seen historically in other bear markets where we've seen rallies above that in 20% range and then go back and hit lows again. So, I don't necessarily think we're out of the woods by any stretch, but there's been some positive signs. I mean, you got small caps have kind of led the way in this rally, which is a good thing. High yield bonds have turned around. So those are some of the things that we're seeing, at least.
And I think the one thing that we can all attest to in our career, the one thing that we learned is nothing happens in a straight line. So to think that the market goes down to the bottom and corrects, although I guess I can say April of 2020 was a huge V-shaped recovery, but that's not normally what we see. And so to think that the market has bottomed and the only way up, or the only way is up from here, or to say inflation's peaked and it's only going to go down, I would say that we'll probably see inflation continue to change up and down from month to month, just as we'll see the market. So I think directionally, but it doesn't seem like to your point, it's not over yet.
I would say too, I think the biggest things continue to go back to what's happening with inflation and what's the Fed doing about it, right? Those seem to be the major drivers. And I think we're getting a refocus back on fundamentals of companies too, right? I mean, going back to corporate profits, I think that's another thing that's coming back into play. So
it's almost the individual stock picking, right? You see from a sector be like it's going to cost more. So the consumer's probably not going to spend a lot. And so you think about The retail sector is going to take a big hit, but it is still individually. Walmart came out good earnings. They've done a great job. Target came out. They didn't do such a good job, both in the same sector, maybe not on the same level from a quality standpoint, but it does matter who's running the company and how they're doing that.
Yeah.
Linda, another one kind of off of your slide on the housing market and the decline question on. So is this another 2008? We're going to continue to see just a housing market crash where we peaked and now we're down for, I don't know what, 18 more months of slide. Is that where you feel like we're headed?
No, I don't see a crash. We certainly have far better loan underwriting than we had after 2008, right? Leading up to 2008, we called them liar loans because people just made stuff up, and we, the mortgage industry, gave loans to people who didn't deserve to have loans. That's changed, and we certainly have better underwriting of the loans that are out there. So I don't see a crash, but the fact of the matter is, a year ago, if you got a mortgage under 3%, for a 30-year, your payment was nice and healthy and low. And today, to get that same low payment, you either have to buy 25 to 30% less house, or the prices have to come down. So, simple law of water finding its own level, math, whatever you want to call it, prices have to come down. And we have started to see hints of that, right? I talked about 60% or more of houses in Arizona in the last 60 days have dropped their prices, but it's seller reticence, right? It hasn't occurred to sellers yet that life has changed. There are not lines out the door anymore. There are not multiple offers anymore. What's happening now is you're having to lower your price to get attention, but the sellers are still reticent because last week or last month, my neighbor down the street got $1 million for their house. And so mine's nicer. I should get $1.1 million. It hasn't sunk in yet that it's changed. So the price decreases that we talked about, $5,000, $20,000, pretty nominal. So we really are at an inflection point in real estate here. I would expect to see prices go down over the course of the next year-ish. But as long as we have a supply constraint, then maybe they don't go down as fast. So I don't see a 2008 style crash. I don't think we have the elements to that here, but I certainly think we've gotten over our skis a little bit on the prices.
And I think it's probably some of the recency bias as well, right? Where it's like, what are we used to right now? And it's funny, right? Some of the headline stuff where it's like, housing market's really declining. There's houses out there that have been on the market for 60 days, which is supposed to be a shocking number. And you think, okay, well, there was a time where you could expect 6 to 9 months was a normal time you could put it out. And, but we're not used to that, where it's like, I put it on the market today and it sells tomorrow and it's and way above. And so it's just trying to getting used to what's normal. There's a similar question that kind of came in on the inflation and jobs and all the announcements of layoffs. And Linda, you touched on it a little bit on what do we feel is a normal unemployment rate, right? So if we have layoffs at 3.5% unemployment and we move to 4.5%, is that long-term bad? I mean, for the people that get laid off, it is, but from going back, Jake, to your comment, Econ 101 is, 5% unemployment is long-term sustainable. And so if we go from 3.5 to 5, and you can have some layoffs and things are getting worse. But mathematically, academically, are we still okay with that? Yeah, that's kind of normal. We haven't seen that in a while.
And that's what's going to upset markets, right? It's just that, oh, wait, that's different. That's not good. But the fact of the matter is, getting back to equilibrium is still survivable from an economic standpoint. It's just going to feel bad from a market volatility standpoint.
Yeah. And I think the big question is, when you look at inflation and growth, right? Does inflation come down, but also growth what comes down faster, and that I think is what the Fed's kind of looking at, right? Is don't want to slow things too much, but we got to get inflation under control. It can't stay at 8, right? Can we get it down?
Yeah, that's the question that we posed in our best case, worst case, base case scenario is, can the Feds engineer a soft landing?
And it's one of those things. I mean, I joined Copperwind in 2011 after the 2008 crisis, Great Recession. And at that time when I came in, you and David were talking about there's going to be inflation, right? Fed can't keep rates forever. And we weren't doing webcasts back then, but we've been talking about we're going to have inflation for a decade. And now it actually has happened. So to think, and Linda, you've kind of made these comments, we spent, I don't know, 100 years globalizing our planet, and then we shut it down for 2 years. And prior to that, we had 10 years of zero interest rates. So to think that, June was market bottom and July was peak inflation, and now we're good after everything that happened, that seems like a stretch.
Yeah.
The ripple effects. Karina, somebody had sent in a question on your I-bonds slide on, so should young people buy I-bonds? You had mentioned, it's a 30-year investment, or could be. You touched on the college planning part. Is there an age that's appropriate? That would you say?
Yeah, that's a great question. I think it's our favorite answer here. It depends. So it's really going to depend on kind of the situation. I know a lot of younger people do stay away from bonds, but they may make sense depending ultimately on like, what are the goals with the funds that you're going to be investing. Although those savings accounts interest rates are slowly creeping up, like Jake mentioned earlier, they're still low. So I-bonds might be an option for a more like short to medium term goal, since you may lose a little bit those 3 months of earned interest if you redeem them before 5 years, but still you can put them in there for a year, earn a little bit on it, protect that principal. So the short to midterm goals, and then like you just mentioned, like I mentioned earlier, for young parents, it's a college savings option as well to consider. So there are still reasons. I don't think age really plays a matter in here. It's more, what is the intent behind investing those funds?
I think we would be buying a lot of them if they were available to in a brokerage account. That's the problem, right? Is you just are limited on the amount, and you got to go buy them through Treasury Direct. So
yeah, and I think that's why when we say, are they a safe place right now? Yes, but for a smaller amount, right? You can't go ahead and put your entire account into it or anything like that.
unfortunately.
We're getting towards the top of the hour. I haven't seen any more questions come in. So I want to thank everybody again for joining us. There's going to be a survey that pops up when you log off. So if you could just take a few minutes and answer the questions, that'll help us improve our webcast. Right now, we're planning on having our next webcast sometime in November. So kind of post-election, pre-holiday, pre-end of the year. So that should be interesting topics. Looks like between now and then I need to work on getting a bookcase behind my desk. I'm the odd man out. I'm not sure why that happened, but I'll work on that. So again, thank you all, and enjoy the rest of your Wednesday.
Thanks, everybody.
Thank you.